Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. I hope you're doing well. Excited to share with you today an update and talk about FHA mortgages. Today, we're going to bust the myths surrounding FHA mortgages, talk about the facts and some of the nuances with those types of loans. So for those that aren't familiar with FHA loans, they are particularly positioned as a first-time homebuyer loan. And that is because it has a very low minimum down payment requirement, 3.5% down. So if you have enough for 3.5% down plus your closing costs and prepaids, that's a low barrier of entry to purchase a home. It also has some credit flexibility. The credit flexibility offers interest rates and financing for credit scores down 580 and up. And then if you have a higher down payment you have lower credit in the range of 500 to 579, it's difficult but still possible to qualify for an FHA loan as long as you have 10% down payment. So there's a little bit of a change there if you have a lower credit score. To compare that with conventional, having a credit score of 580 to 640 or so makes it very, very expensive or not even possible to qualify. So that flexibility offered on FHA is extremely helpful. It also has high debt-to-income qualification permissions. So normally, conventional loans, we want to keep our total debt-to-income ratio, DTI, alphabet soup time. We normally try to keep that below 50% for the total debt-to-income ratio, and your housing ratio below 42% thereabouts. Below 45, we could still work with compensating factors. There's different ways to structure, but by and large, 50%. With FHA loans, you do have some flexibility with compensating factors to be qualified for an FHA loan, 50% to 55%, as long as that housing ratio, where we only compare your gross income to the proposed debt of the property, is low enough in those circumstances. So some more flexibility for your qualification there. Use cases for FHA loans. They are available to all qualified buyers. They are not just a first-time homebuyer loan. As much as it gets positioned as a first-time homebuyer loan, like we talked about the 3.5% down payment, it is not exclusively a first-time homebuyer loan. You can use this, which sounds like I'm busting a myth, right? All right, now let's focus in on that. Let's do that together. So here are the common myths of FHA loans debunked. First myth, only for first-time homebuyers or low-income buyers. Wrong. Reality is there's no income caps and you do not need to be a first-time home buyer to have access to an FHA loan. Myth, always more expensive than a conventional loan. Reality, no. FHA rates are normally lower. You know from my weekly updates on this podcast that we take a look at interest rates, and the FHA mortgage interest rates are always lower than conventional mortgage interest rates on average throughout the country. So that's a benefit. The APR, though, may be higher. The APR isn't the interest rate, but rather you can think of it as kind of a barometer of your financing. So the APR takes into account your interest rate, the cost of the money you're borrowing, and then adds in through a calculation all of your financing costs, which include, in particular in the FHA scenario, an upfront mortgage insurance premium that is actually built into your loan commonly, and then a monthly mortgage insurance premium, and then all of your loan costs. They get lumped in and added through a calculation to what your interest rate is to show you the APR. And the purpose of that APR to show you a barometer of your financing so you could quickly look and see how much your total cost of financing is looking like for the property that you're purchasing. So it's not your actual interest rate. It's just to show you. So if you look at your interest rate, let's say it's 6.35% for your FHA mortgage, and then you see 7.25% APR. You're paying back an interest rate of 6.35%, but the 7.25% APR is just showing you because of that upfront mortgage insurance premium, because of your loan costs. It has higher costs for the financing. Doesn't mean it's more costly totally out of pocket and whatnot like that. Compare that to a conventional loan now. If you see 6.5 on your conventional loan interest rate and then 7.5 for your APR, pump the brakes. You're paying more for your financing. That's indicating to you very quickly high cost financing. If it's within about 0.5%, that's normal, thereabouts. Let's go back to those myths. All right. Large down payments eliminate mortgage insurance. That is not true. With FHA loans, the mortgage insurance premium is always going to be paid, no matter what your level of down payment is. Next myth. Student loan debt disqualifies you from an FHA loan. No, that is not true. As a matter of fact, FHA loan guidelines do permit for student loan debt and also has some provisions to help with the qualification when you have student loan debt. Now, what I will say to that is if you were delinquent on student loan debt, if you have late payments or went into delinquency, that could preclude you from financing. FHA is a federal loan, and your student loans are federal loans, so federal debt gets weighted more heavily if you're late or delinquent on federal debt, and that could preclude you from financing for a period of time. Now let's talk about the mortgage insurance premium. I brought that up a couple times during these myths and the debunking. So there's an upfront mortgage insurance premium. It's 1.75% of your loan amount. That's a cost that you don't pay at closing, but it gets added in to your mortgage balance. So you're going to be repaying that in your monthly payments because it's part of your loan. And that is a charge. That 1.75% charge is the function that actually creates the higher APR on FHA loans, even though you're getting a lower interest rate by and large. The annual mortgage insurance premium, that they call it annual, but you pay it monthly. That varies depending on your down payment, what that cost is, but it is standard. I'm going to do a separate episode just on mortgage insurance, again, to refresh everybody on this. So stay tuned for that. But for our purposes right now, your down payment amount will dictate how much that annual mortgage insurance premium is. And then the other thing that the mortgage insurance premium has as an impact to the financing based on the down payment is if you put 10% down or more, you will lose the mortgage insurance. It will drop off after 11 years. So that's something to consider. If you have a down payment of less than 10%, you're going to always pay that annual mortgage insurance premium monthly until you refinance that debt into a conventional loan when you've reached the proper equity level. We compare that with a conventional loan. You will be paying mortgage insurance, and I'm saying it differently because there's a distinction. Mortgage insurance premium, it's a premium standardized. On conventional loans, it's private mortgage insurance, PMI. I'll just refer to that as mortgage insurance because that is actually priced and based on your particular loan qualifications. So that's a tangible difference between the two. When we look at a conventional loan, when you reach 22% equity, it's supposed to automatically fall off. So that's a tangible difference when it comes to mortgage insurance premiums. Now let's go and do a comparison, pros and cons of FHA loans. Pros, one, it's giving you more access. There's more access to more financing to more buyers. So it's helpful from that standpoint. Secondly, gift funds are allowed for full down payment. That does vary from conventional, but you can get 100% of the money that you need to purchase a home as a gift from a family member or relative. 3, it covers a wide variety of property types, 1 to 4 units, condos, manufactured homes, energy efficient, and 203K renovation loans. So there's renovation loans available with FHA. The only thing to consider, if you're purchasing a condo with an FHA loan, there's an additional approval process for the condo, which is a little bit more detailed than your conventional approval process for a condo. So that's something to be aware of. Also, some condos are already listed on the FHA's approved condo list. That's something to check out. So if that's something you're interested in, reach out and I can give you some guidance on that. Last pro is it can be used multiple times. That's the other myth that we just busted here together. Most people think you can only use it once, but you can only use FHA mortgages on primary residences. So bear that in mind. If you're going to purchase a home as a primary residence, you're going to need to use an FHA loan for that. If it's a primary residence, that's the only scenario you can use an FHA loan for. Now let's talk about some of the cons. Mortgage insurance premium can be costly. As I mentioned, 1.75% upfront plus the annual. So that's something that compounds over time, and that's money that does not benefit you at all. Quick refresher, mortgage insurance is an insurance policy. and a premium that you pay for as a homeowner when you put less than 20% down that protects the lender in the event that you default. That's mortgage insurance. It does not benefit you as a homeowner at all. You are paying for protection for the lender. Quick side note on that. Other con, stricter appraisal standards. This is an important one. FHA appraisers will need to follow more particular guidelines, and they are going to be more likely to flag things in the property and flag things that they see that may need to be repaired. So that's an important element. Also, in the psychology of the seller, part of the reason why these FHA loans are not as appealing to a seller when they get those offers, which is another con. Sellers do not look favorably upon FHA loans. This is not okay. It's not something that should be part of the calculus. It should be based on the merit of the offer and the terms of the offer. But mortgage is part of the terms because it's communicated on the contract in New Jersey. So that is something that can be considered. So as an FHA buyer, it doesn't get looked favorably, especially if the home seller has any concerns about the property, which isn't the worst thing in the world. Looking at the glass half full, I'll be an optimist. Maybe they're saving everybody from a headache of process if there is something that gets flagged by the appraiser. Loan limits vary. So there are limits to how much of a loan you could take out with an FHA mortgage, and they vary county to county. If we're in New Jersey, we're in a high cost area, so that's really not too much of a concern. There's 2 counties, I believe, that don't qualify for the high cost area, and one of them is definitely Warren County, and I'm pretty sure the other one's Camden. Don't quote me on that, though. I'll have an update on that next episode. But for now, most of the state has the increased loan limits that are permissible in high-cost areas. So in New Jersey, it's not too much of a concern. And then it's not usable on vacation homes or investment properties. Like I said, exclusively for primary residence purchases where you're going to live in the property. But that could also mean multifamily homes and things like that. For context, looking back at last year, 1 in 5 homebuyers used an FHA loan. So it's an appealing program. 100% of down payment can be covered with gift funds. That's a key highlight I wanted to hit again. Another key highlight, FHA has renovation available. So if you wanted to get financing for renovations on a property, that is possible with an FHA loan. Unless you have 10% down, key highlight, you will be paying annual mortgage insurance premium for the life of the loan. If you have 10% down or more, you'll be paying that for 11 years or until you refinance into a conventional loan. And then lastly, you can use an FHA loan multiple times as long as it's a primary residence. That being said, there are particular guidelines around that. If you're moving across town, sometimes you won't be able to use an FHA loan on the subsequent purchase. It will depend on the situation, how much time you've spent in that property, things like that. If you have particular questions about that, I'd encourage you to reach out. So that's it for today. I hope you found this deep dive on FHA mortgages helpful and useful. Feel free to reach out, like, share, subscribe, follow me on socials. It would be great to connect with you and hear some of your thoughts and what you think would be helpful on the show. Always happy to give you what you need and what you'd be interested in. In the meantime, I look forward to our next update, giving you the weekly update later on this week. Until then, make it a great day and take good care.